Are you tired of watching your trading account go up and down like a roller coaster? Do you dream of consistent profits and financial freedom through trading? Well, you're in the right place. In today's video, we're diving deep into the 10 essential things you absolutely must do to become a consistently profitable trader. This isn't about get-rich-quick schemes or magic formulas. This is about building a solid foundation, developing the right mindset, and implementing proven strategies. So, buckle up, take notes, and let's get started on your new journey to profitable trading. Let's jump right into our first crucial step. Step 1. Develop a solid trading plan. If you want to make money through trading, keep it, and invest it properly in order to achieve financial freedom, you need to develop a solid trading plan to be able to achieve that. Think of your trading plan as your business blueprint. Would you start a business without a plan? Absolutely not. The same applies to trading. Your plan should clearly outline, number 1, your trading goals. What do you realistically want to achieve? Set both short-term and long-term targets. Are you aiming for a specific monthly return or building capital for a larger goal? Think and be clear about what you really want to achieve. And once you have a clear plan, you would now need to know your. Number 2, risk tolerance. You know every business carries risk, and in trading the risk is the foundation of the business. And the most interesting thing about that is that when you are aware of the risk, you are now free to determine your risk tolerance. How much capital are you willing to risk in your trading business? How much are you going to be risking on each trade? This is paramount for protecting your trading account, because once you open it, the money you have in your account is now entirely in risk environment, and your main job then is to be able to protect your capital fiercely. I know you may ask, but how am I going to make money just by protecting money? And I understand your point. You see, the only business that has the right to take your money away from you quickly is trading. And to be able to make money, you need to know how to protect your money in this business first. Define exactly the maximum percentage you'll risk per trade, 1 to 2%, for example. Number 3, your trading style. Are you going to be a day trader, a swing trader, a position trader, or scalper? Each style has different time commitments and risk profiles. Choose one that aligns with your personality and availability. A day trader is a trader who opens and closes his trade positions within a day range in the market. A swing trader can hold his positions for several days or weeks. A position trader can hold his trades for several weeks and months. And a scalper looks for quick profit in the market within some minutes or some few hours. Choose one style and stick to it. Number 4, your market focus. Will you trade Forex, stocks, cryptocurrencies, commodities, or a combination? Focusing on a few markets allows you to develop expertise. Nobody reaches excellence in any market by moving from one to another. You have to choose 1 or 2 of the markets and strive for excellence. Number 5, your entry and exit strategies. What specific conditions will trigger you to enter a trade? And, equally important, what are your predetermined profit targets and stop-loss levels? Don't trade impulsively. Without a well-defined trading plan, you're essentially gambling. Take the time to create a detailed plan and stick to it. This will provide structure and discipline to your trading. Step number 2, master risk management. I know a lot of beginner traders underestimate risk management. I can't stress this enough. Risk management is the cornerstone of profitable trading. It's not about how many winners you have, but how well you manage your losses. Key aspects include position sizing, Calculate your position size based on your risk tolerance and the stop-loss level for each trade. Never risk a fixed amount that could significantly impact your capital. Stop-loss orders. Always use stop-loss orders. This is your safety net, automatically closing a losing trade at a predetermined price. This prevents catastrophic losses. Risk-reward ratio. Aim for trades with a favorable risk-reward ratio, like 1:2, 1:3, or higher. This means you're aiming to make at least twice as much profit as you're risking, or 3 times your risk amount. Avoid over-leveraging. Using excessive leverage can amplify both your profits and your losses exponentially. Trade with a comfortable level of leverage that you understand. You might probably experience this when you open a position with a big lot size, and when the trade moves against you some few pips, you saw your account on a serious drawdown, and when you are afraid and cut your losses, then the trade turns back all the way to your take-profit levels, don't you? That is the result of over-leveraging. Learn to use right leverage for your trades, and you will be safer and more comfortable with your drawdowns. Don't average down on losing trades. This emotional reaction often leads to bigger losses. Stick to your initial plan and accept that some trades will be losers. Average down, which stands for opening more positions. As a trade starts moving against you, almost always leads to bigger losses, destroys you risk management rules, and it also has the right to take away all your money. It's one of the reasons many people blow up their trading accounts. Effective risk management protects your capital and allows you to stay in the game long enough to become profitable. It's the difference between a sustainable trading career and a quick burnout. Step number 3, develop a profitable trading strategy. Once you have your plan and risk management in place, you need a strategy that gives you a statistical edge in the market. This involves choosing a strategy. Research and learn different trading strategies, like trend following, trends breakout trading, range trading, price action. Find one that suits your trading style and market focus. Understanding the logic. Don't just blindly follow a strategy. Understand why it works and the underlying market principles. Backtesting. Before risking real capital, rigorously backtest your chosen strategy on historical data. This helps you assess its potential profitability and identify its strengths and weaknesses. Forward testing, demo trading. After backtesting, practice your strategy in a demo account with virtual money. This allows you to get comfortable with the execution and identify any practical challenges. Adaptability. The market is constantly evolving. What works today may not work the same way tomorrow. Be prepared to adapt your strategy as market conditions change. A well-defined and tested strategy provides you with clear entry and exit signals, reducing emotional decision-making and increasing your probability of success. Step number 4, practice consistent chart analysis. Understanding price action and market structure is crucial for making informed trading decisions. This involves identifying trends. Learn to recognize uptrends, downtrends, and sideways consolidation. Trading in the direction of the dominant trend increases your odds. Support and resistance levels. Understand how to identify key price levels where buying or selling pressure is likely to emerge. Technical indicators. Familiarize yourself with various technical indicators like moving averages, RSI, MACD, Fibonacci, and how they can provide potential entry and exit signals. Don't overload your charts. Focus on a few that you understand well. Price action patterns. Learn to recognize candlestick patterns and chart patterns that can indicate potential price movements. Time frame analysis. Understand how to analyze charts across different time frames to gain a comprehensive view of the market. Consistent chart analysis helps you identify high-probability trading opportunities and understand the overall market context. Make it a daily habit and you'll set yourself up for success. Step number 5. Manage your trading psychology. This is arguably one of the most challenging aspects of trading, but it's absolutely critical for long-term profitability. Common emotional pitfalls include fear of missing out, FOMO. Avoid jumping into trades impulsively because you're afraid of missing out on a potential move. Stick to your plan. Greed. Don't let winning trades make you overconfident or deviate from your strategy. Take profits according to your plan. Fear of losing. Don't close winning trades too early out of fear of them turning into losers. Also, don't hesitate to cut your losses when your stop loss is hit. Revenge trading. Don't try to recoup losses by taking impulsive and poorly planned trades. This usually leads to further losses. Overconfidence. After a series of wins, don't become complacent and start taking unnecessary risks. Developing emotional discipline takes time and self-awareness. Journaling your trades and analyzing your emotional responses can be incredibly helpful. Understand that losses are a part of trading, and it's how you react to them that matters. Step number 6. Start small and scale gradually. Don't try to become a millionaire overnight. Begin with a capital amount that you can afford to lose without significant financial impact. Focus on percentage gains. Initially, focus on achieving consistent percentage gains rather than large absolute profits. This builds good habits and confidence. Master your strategy. First, ensure you have a proven and consistently profitable strategy before increasing your position sizes. Scale gradually. As you gain experience and consistent profitability, you can gradually increase your capital allocation per trade, always adhering to your risk management rules. Rushing the process and trading with too much capital too soon is a recipe for disaster. Patience and a gradual approach are key to sustainable growth. Step 7. Keep a detailed trading journal. Your trading journal is your personal trading logbook and a powerful tool for self-improvement. Regularly reviewing your trading journal helps you identify patterns in your winning and losing trades, understand your emotional triggers, and refine your strategy over time. It's like having a personal trading coach. Step number 8. Continuously educate yourself. The financial markets are constantly changing, so I personally think learning should never stop. Read books and articles. Stay updated on trading concepts, strategies, and market analysis. Follow reputable sources. Learn from experienced and successful traders. Be wary of get-rich-quick gurus. Take courses and webinars. Consider investing in quality trading education to deepen your knowledge. Analyze market news. Understand how economic events and news releases can impact the markets you trade. Stay curious. The more you understand about the markets and trading principles, the better equipped you'll be to make informed decisions. The most successful traders are lifelong learners. Embrace the journey of continuous improvement. Step 9. Be patient and persistent. Profitable trading is not an overnight success story. It takes time, effort, and dedication to develop the necessary skills and consistency. Understand the learning curve. There will be ups and downs. Don't get discouraged by initial losses. Focus on the process. Concentrate on executing your plan and strategy correctly rather than solely on the outcome of each trade. Don't give up easily. Many aspiring traders quit just before they are about to see results. Persistence is what separates winners from losers. Celebrate small wins. Acknowledge your progress and learn from both your successes and failures. Trading is a marathon, not a sprint. Cultivate patience and stay persistent through the inevitable challenges. Number 10, review and adapt your approach. The market is dynamic, and what works today might not work tomorrow. Regularly review your trading plan, strategy, and performance. Analyze your results. Periodically review your trading journal to identify what's working and what's not. Be open to change. Don't be afraid to adjust your strategy or plan if market conditions change, or if your current approach isn't yielding consistent results. Seek feedback carefully. If you're part of a reputable trading community, consider seeking constructive feedback on your approach. Stay objective. Avoid emotional attachment to your strategies. Be willing to discard what isn't working. Continuous review and adaptation are essential for staying ahead in the ever-evolving world of trading. So there you have it. 10 crucial things you need to do to become a profitable trader. Remember, this is a journey that requires discipline, patience, and a commitment to continuous learning. If you found this video helpful, please give it a thumbs up and subscribe for more trading insights and strategies. Let me know in the comments below which of these tips you're going to focus on implementing first. Thank you so much for watching our videos, and I wish you all the best on your trading journey. Love you and love trading. Thank you.